Three men purchased a failing combat sports brand in January 2001 for just $2 million. By 2024, SEC filings from its parent company valued that same promotion at $12.1 billion. Yet behind this legendary windfall lies a brutal economic reality that routinely bankrupts almost everyone else who attempts to run a live fight event. UFC owners built one of the greatest returns on investment in sports history, transforming a mocked spectacle into a global entertainment giant. This represents the gold standard of sports promotion, drawing in millions of viewers and securing massive television broadcast rights deals. Outside the bright lights of Las Vegas, the numbers paint a starkly different picture for the promoters who actually build the sport from the ground up. Local promoters spend their weekends in drafty high school gymnasiums or suburban hockey rinks, carrying the entire weight of the production on their shoulders. Promoters pay their fighters out of pocket, often using their personal savings or day job salaries to cover the final balance sheet. Fighting promotions must deal with a balance sheet where every single dollar is fought for and every ticket sale determines if they survive another week. Many local events run at a loss, kept alive solely by the passion of owners who can't walk away from the sport despite the rising debt. Understanding this business requires looking past the pay-per-view spectacle and focusing on the grim arithmetic of the regional circuit. You have to examine the actual ledger of a local show, where the costs of regulatory compliance and venue rental dwarf any incoming ticket revenue. Financial margins are razor-thin, meaning that even a minor mistake in matchmaking or venue booking can trigger immediate financial ruin. Risks are immense because every fight card is a high-stakes gamble with no guarantee of returning a single dollar of profit. Combat sports possess one of the most passionate fan bases in the entire entertainment industry, filled with loyal supporters who follow the sport religiously. Dedicated supporters buy tickets and purchase merchandise with fierce loyalty that keeps the regional scene alive. Organizers occupy the absolute center of this ecosystem, balancing the conflicting demands of fighters, fans, advertisers, and broadcasters on a weekly basis. From the outside, the business model looks deceptively simple to anyone who has ever watched a sold-out arena on television. Sell tickets, book matchups, collect sponsor money, and pocket the difference after the final bell rings. That simple equation ignores the crushing reality of building an audience from absolute zero in an oversaturated entertainment market. New promotions can't rely on name recognition or television deals to draw crowds, meaning they must market every single fight individually. Instead, they face a mountain of regulatory hurdles, massive production costs, fighter payrolls, and marketing expenses before they sell their first ticket. Most aspiring matchmakers assume their passion will translate into ticket sales, only to realize that enthusiasm does not pay the stadium lease. They quickly learn that passion does not pay the arena rental or cover the cost of the mandatory medical personnel at ringside. Before a first fight is scheduled, a promoter has already committed thousands of dollars to state regulators just to secure permission for the event. Every state in the country requires a separate athletic commission license to run a combat sports event, meaning you can't easily tour across state lines. No national licensing system exists to streamline this process for promoters looking to expand their geographic reach. Operating in New Jersey requires one license, while Nevada demands another, forcing promoters to satisfy entirely separate government bureaucracies for every single venue. These licensing packages aren't cheap, often requiring non-refundable fees before the commission even reviews the application. State commissions demand surety bonds ranging from $2,000 to $10,000, depending on the local jurisdiction, to protect against promoter default. Regulators also require the promoter to deposit the total fighter purse into an escrow account before the event occurs, locking up valuable liquid capital. Sanctioning fees add another $500 to $3,000 to the pre-event bill, depending on the size of the venue and the number of fights. Certain states charge a percentage of the total gate revenue instead of a flat sanctioning fee, eating directly into potential profits when ticket sales are high. Medical compliance costs present another major financial hurdle that must be cleared long before the first bell rings. Commission medical bills run anywhere from $500 to $2,000 per card to cover the cost of official ringside doctors. Matchmakers must pay for pre-fight physicals, detailed blood work, neurological screenings, and ringside physicians for every fighter on the card. If a fighter fails their medical screening, the matchup is cancelled, but the medical bill remains on the promoter's ledger with no way to recover it. Paying these government fees doesn't guarantee success to the person hosting the event. It grants the legal right to host a fight without providing any of the physical infrastructure needed to actually run the show. Actual production expenses are a completely separate ledger, requiring thousands of dollars in additional investment before the doors open. Venue rental fees represent the largest single physical expense for a regional show, requiring negotiations with local stadium managers. Renting a facility with 2,000 to 5,000 seats costs between $5,000 and $25,000 per night, depending on the location and date. Once the venue is secured, the promoter must install the fighting cage, which requires specialized transport and assembly crews. Purchasing a high-quality cage costs $8,000 to $15,000 outright, representing a major initial capital investment. Securing a cage for a single night costs between $2,000 and $5,000 if the promoter chooses to rent the equipment instead. Broadcast quality lighting is another mandatory expense that promoters can't afford to skip if they want to attract television distributors. Professional lighting rigs run between $2,000 and $8,000 per event to ensure the action is visible for the cameras. Audio equipment and public address systems add $2,000 to $6,000 to the tally, ensuring fans can hear the announcer. Modern audiences expect high-definition streaming, which requires multi-camera production and professional replay systems. Streaming production packages cost anywhere from $3,000 to $30,000, depending on the crew size and broadcast quality. Officials must also be paid, with rates set by the state commission rather than negotiated by the promotion. Hiring 3 judges, one referee, and 1 inspector costs between $1,500 and $3,000 per night depending on the state. Drug testing protocols add another layer of expense, with commissions demanding random tests to ensure athletic integrity. Testing 20 to 28 fighters costs between $5,000 and $14,000 depending on the depth of the chemical screening. Total production costs for a regional event run from $25,000 to $60,000, representing a massive financial burden. All of this must be paid before a single fighter receives a check, meaning the promoter is deep in the red before the first spectator arrives. Running these shows requires significant upfront capital, which often forces promoters to take on personal debt or seek outside investors. Without sponsorships or ticket sales, the promoter is entirely exposed to the financial ruin of a poorly attended event. One cancelled main event can wipe out an entire year of profits, leaving the promoter with venue bills and no ticket revenue to pay them. The cost of the physical event is only the beginning of the ledger, as fighter compensation remains a major separate cost. Compensation for the athletes in the cage is the next major budget item, requiring careful negotiation with managers and agents. Typical regional promotions use a structure consisting of a show purse and a win bonus to incentivize performance and manage cash flow. Under this system, the fighter is guaranteed a set amount just for stepping onto the scale and entering the cage on fight night. Winning the fight doubles their paycheck, creating a massive financial incentive that drives the action inside the cage. Regional standards for these purses typically range from $500 to $2,500 to show, with an equivalent amount to win. A standard 14-fight card featuring 28 fighters costs the promoter between $33,000 and $38,000 in total athlete compensation. Aspiring fighters accept these low rates because they need the experience and exposure to catch the eye of major organizations like the UFC. Elite promotions like the UFC operate on a completely different scale, generating hundreds of millions of dollars in television rights. SEC filings reveal that the UFC allocates roughly 16 to 20% of its revenue to fighter pay, keeping their labor costs remarkably low. Major team sports like the National Football League and the National Basketball Association pay their players closer to 50 or 57% of total revenues. MMA fighters receive a much smaller piece of the pie because they lack a union, preventing them from bargaining collectively for better terms. Every fighter operates as an independent contractor, negotiating their own terms without collective bargaining power or shared revenue agreements. Without a union, athletes can't demand a fixed share of the sport's growing revenues, leaving them at the mercy of dominant promotions. This structural imbalance keeps labor costs low for promoters at the top, allowing them to accumulate massive cash reserves. But for local promoters, even a low labor bill can break the budget if ticket sales don't meet expectations. Finding the money to pay 28 athletes requires a steady stream of incoming revenue from sponsors and ticket sales. Ticket sales aren't enough to cover the payroll, as venue capacities on the regional circuit remain relatively small. Alternate revenue streams must be developed to bridge the financial gap, forcing promoters to get creative with sponsorships. Revenue sources for regional events are highly unpredictable, depending heavily on local matchups and community interest. Ticket sales represent the primary source of income, but the numbers rarely reach their theoretical maximums due to unsold seats. Selling out a 2,500-seat arena with tickets priced between $25 and $40 could bring in $30,000 to $100,000. Realistic expectations for a standard show hover closer to $50,000 once complimentary tickets and promoter giveaways are accounted for. First-time events often struggle to attract more than 500 to 1,000 spectators, despite expensive local marketing campaigns and social media promotion. Ticketing platforms take a massive cut of these receipts, with fees running between 10 and 15% of the ticket face value, reducing the promoter's net. Broadcast and streaming rights offer another potential stream of cash, but only if the promotion can secure a reputable distribution partner. Distribution outlets might pay between $5,000 and $25,000 per event for broadcast rights, which barely covers production costs. Corporate sponsorships provide the final piece of the revenue puzzle, requiring promoters to pitch local businesses for months before the event. Brand new promotions can expect to generate only $500 to $5,000 in sponsorship money from local auto shops or bars. Established promotions with a track record can command between $5,000 and $30,000 from national brands or local casinos. When you compile these figures, the math becomes sobering for anyone dreaming of quick profits in the fight business. An established regional promotion might generate $75,000 in total revenue for a single card, combining ticket sales and corporate sponsorships. Operating expenses for that same card could easily reach $78,000 once you account for production equipment and fighter pay. The promoter is left with a net loss of $3,000 for months of full-time work, forcing them to absorb the deficit. Debt is often the only way to cover these recurring losses, leading to a cycle of borrowing to fund the next event. Many organizers survive by funding shows through personal credit lines, hoping that the next card will finally be the one that breaks even. They hope that a breakout star will eventually lift the promotion into profitability or attract the attention of a major buyer. Broadcasters face equally difficult economics when scaling combat sports on a global level. Discovering that the audience doesn't behave like traditional sports fans, streaming giant DAZN invested over $1 billion in boxing rights between 2018 and 2022, aiming to disrupt the pay-per-view model. Deals with Matchroom Boxing and Golden Boy Promotions were intended to build a massive subscriber base that would pay a recurring monthly fee. Executives believed that premium combat sports could drive consistent monthly subscriptions, mimicking the success of platforms like Netflix. Subscription growth didn't match expectations, as the platform struggled to retain casual fans after major fight nights ended. Boxing fans traditionally purchase individual events on pay-per-view rather than maintaining recurring monthly memberships, which disrupted the business plan. Public financial reports documented heavy losses as these rights deals underperformed, forcing the streaming service to raise subscription prices. Audiences for combat sports behave differently than audiences for general entertainment, demanding specific stars rather than general content libraries. Fans will pay premium prices for a single high-profile matchup but cancel their subscriptions immediately afterward, creating massive churn. Predictable monthly income remains highly elusive in the fight business, even for companies with deep pockets and global reach. Even large media companies struggle to turn a profit on live events, highlighting the fundamental instability of the fight promotion model. Lower-tier promotions have even less leverage when negotiating broadcast rights, often forced to buy airtime rather than selling it. Negotiating power rests entirely with the distributors who control access to the screen, leaving independent promoters with very little leverage. Lacking distribution leverage, the promoter is trapped in a race to the bottom, spending more on production than they can ever recover. Consolidated leagues are the natural result of this structural pressure, as promotions merge to build bargaining power against broadcasters. Mergers and acquisitions shape the upper tiers of the sports business as organizations try to achieve the scale necessary to compete. Bellator MMA operated at a loss for years, relying on corporate backing from Viacom to cover their production deficits and fighter salaries. Cable network Showtime eventually provided a broadcast home that stabilized their finances, but the promotion could not narrow the gap with the UFC. Despite this support, the promotion struggled to achieve true profitability, leading to its eventual sale as corporate priorities shifted. Professional Fighters League acquired Bellator in 2023 for approximately $125 million to expand their roster and distribution. Industry reports from the Sports Business Journal confirmed the deal value, marking a major consolidation in the mixed martial arts market. Combining these organizations was designed to create distribution leverage against the dominant UFC, giving the PFL a stronger position. Consolidation has become a recurring theme in combat sports history, driven by the need to secure valuable television contracts. Smaller players must unite or risk being choked out of the market by dominant players who control the major media partnerships. Collective scale allows these leagues to negotiate better television contracts, which are the lifeblood of any major sports organization. Contracts with networks are the only way to secure guaranteed revenue, protecting the promotion from the unpredictable nature of live gates. Television deals protect promotions from the volatility of individual event ticket sales, ensuring a steady stream of income regardless of matchups. Lacking network backing, regional leagues remain highly vulnerable to fluctuations in local ticket sales and sponsor interest. Survival in this environment requires a clear strategic path that goes beyond simply booking fights and hoping for the best. Successful operators typically follow one of three specific blueprints to keep their promotions afloat in a hostile market. Securing a distribution agreement represents the first path to viability, providing a guaranteed baseline of television rights income. Guaranteed revenue of this nature covers production costs before tickets are sold, protecting the promoter from financial disasters. Niche specialization represents the second path to survival, allowing promoters to target dedicated communities like submission grappling. Focused niches attract dedicated audiences who are willing to pay for highly specialized streaming channels and buy targeted merchandise. Combined business models allow the organization to capture multiple revenue points from the same athlete, representing the third path of vertical integration. Training fees and management commissions flow into the same corporate bank account, offsetting the losses incurred by the promotion. Fighters get regular matchups, while the gym secures cheap local talent to populate its fight cards without heavy recruitment costs. Organizers who fail to adopt one of these strategies rarely survive past their first year in the competitive combat sports industry. Sponsors must be secured as the primary revenue stream rather than a pleasant bonus for the regional promoter. Running more local shows at the same thin margin only accelerates the path to bankruptcy without helping the promotion scale. Behind the historic rise of the multi-billion-dollar fighting empire lies a foundation built on the losses of local promoters who never broke even. That massive valuation in 2024 was built on a brand purchased for only $2 million in January 2001.